Hello and welcome to the Gold Goats and Guns podcast for April 17th, 2025. My name is Tom Luongo. We have a lot to talk about. It is episode 213, and I have the great pleasure of having my good friend Caitlin along back to discuss, well, I'm not really quite sure what we're going to discuss today because we never quite know where Caitlin and I are going to go, but it's always a stimulating conversation where I usually get interviewed as much as I interview her. And that's what I really appreciate having that kind of pushback on the podcast. So Caitlin, good afternoon. Thank you for taking the time and all of that. So how are you?
Yeah, awesome to see you. Doing well, thanks. Yeah, no, I actually, when you reached out to me, I said, look, I want to interview you because I've listened. I've listened to a couple of your most recent podcasts, and the world is changing so fast that you get something out a day or two later and the world has changed by intervening events. And so what I would really love to do is ask you, and I warned you about this, to give the elevator speech version of your view of the world, and as if nobody has listened to you before.
Oh, wow. That's going to be that'll be a tall order. Let's start with the beginning. It's actually a lot clearer than it used to be, and I recommend everybody take a listen to the interview I did last week with Tommy Kerrigan on Tommy's podcast with Ian Burlingame, because I think Ian did a really nice job of putting into historical context a lot of the arguments that I've been making about Davos, the City of London, and all of that stuff. So in ways that I had not really fully considered, because I do not consider myself a historian in any way, manner, shape, or form. And my partner, Dexter White, reminds me of this on a bi-weekly basis, as a matter of fact, being the actual historian in the group. So what I think ultimately, it was, as things play out right here, right now, is that Donald Trump is attempting the first real decoupling of the American financial system broaden that as wide as you want, from the old colonial European system. That if you look over the history of the United States as it pertains to money, since our conception, since, as I've like to said many times, since Cornwallis surrendered at Yorktown, we have never really had financial independence in the United States. And if you don't have financial independence, you don't really have political independence either. So it's, in a way, it gets into that thing that I've said before. How do you feel about the American Revolution? Well, I take a very Chinese view of it and say, well, it's too early to tell. Right. Here we are 249 years since the American Revolution was declared, and we're still fighting the vestiges of that system. So now, but over the course of the past few years, with the advent of SOFR, the secured overnight financing rate, and the true end of LIBOR on March 31st, because while LIBOR ended on September 30th, the 6-month synthetic LIBOR contracts that were floating around out there, they didn't mature and end matured until March 31st. And then, interestingly,
Can I pause you there and explain the difference between SOFR and LIBOR and why that means the U.S. is taking power back from London?
Sure, because the LIBOR rate is an unsecured rate decided upon by 18 City of London banks, only one of which represents your American interests. And in many people's parlance, JP Morgan does not represent America's interests at all. And it's only the JP Morgan's London office or subsidiary that sat on the board of LIBOR. The secured overnight financing rate. And so what this means, before I move on to SOFR. So LIBOR was a way to price offshore dollars without ever having to really post collateral, because you could just pass LIBOR contracts and everybody hypothecate them back amongst themselves and everybody. And we had this massive growth of the shadow banking system in the Eurodollar market over the last 60 or 70 years.
Let me pause you there. For people who are just starting to listen to this for the first time, and underscore, that meant the London banks set the most important interest rate in US dollar markets.
And which then would be the most important markets in the world.
Correct. Okay, great. Now, onward.
Okay, so now that we have that established, and the LIBOR system was codified in 1984, when LIBOR was kind of unofficially established as the U.S. dollar rate around the world. Interestingly enough, we had the G5 get together in 1985 and create the Plaza Accord to now rig currency markets. And then that system really kept it was in play all the way up until I think the global financial crisis of 2008, and that's
Yep.
when systems
It
started to
broke.
break. That's when the whole system started to break, really broke. And then since then, I've said for years that after that period from around 2011, when the central banks all got together and created swap lines amongst all the major G7 banks, the Bank of Japan, the Bank of England, the Fed, the ECB, they all got together and they coordinated monetary policy. And that's actually what broke the last gold bull market. If you remember, that was at that moment in time, it was in that period that gold peaked. Then there was the
Yep.
announcement of the coordination of central bank policy, central bank policy. We were dealing with the potential of Brexit at the time, meaning Germany leaving the euro at the time. That
Yep.
stabilized the markets by the time we got into October, November of that year. And then that, in my mindset, created and that was the end of the quote unquote dollar reserve standard. Now we were into central bank coordinated policy standard. And I think that ends with 2021 and Jerome Powell beginning stealth tightening of the dollar. He didn't start the process of tightening interest rates until his reconfirmation in March of 2020, after his reconfirmation in March of 2022. But in June of 2021, when he raised the payout rate on reverse repo contracts 5 points above the Fed funds rate to stabilize the dollar funding markets. He was able to do that because we had moved off of LIBOR in the United States to the
Yeah.
secured overnight financing rate. The secured overnight financing rate, SOFR, or otherwise known as SOFR, is a secured rate per its name, which
Mm-hmm.
takes which is settled on a daily basis and the rate is determined in a market sense by what's going on in U.S. repo markets and U.S. money markets. And SOFR, since it became the law of the land for all new U.S. debt to be denominated or indexed to SOFR starting in January 1 of 2022. Note the timing here, January 2022, Powell's reconfirmation in February of 2022, his second term starting, and then him starting to raise interest rates in March of 2022, all in a row. That began the shift away from Eurodollar futures being the mechanism by which the tail that could wag the global dollar market dog, to the SOFR futures market, the 3 month SOFR futures market being the thing that determines the cost of dollars over the course of, on a daily basis. And
And
we
just to
saw
pause you
that.
there, can I underscore for those who are not financial market people, the LIBOR market, LIBOR touched everything. LIBOR is the rate at which, or was the rate at which hedge funds targeted their returns. It was the floating rate for corporate floating rate debt, of which there is not much, but the vast majority of corporate bonds were swapped into floating because of the steepness of the yield curve in normal times. So the interest rate swap market was driven by that. So basically, and of course, there's the mortgage market, which was also very driven by LIBOR, right? So you basically had at the core of the huge fixed income markets, which are far, far bigger than the stock market in the United States, you had the most important interest rate that underpinned all of the fixed income market being set by a cabal of London banks. And there was a LIBOR pricing scandal. Guess what? They were fixing the rate. And that was having a huge impact on the US economy.
Yes.
And so, walk us through from a history perspective and talk about John Williams, the role that certain people had in prying the control over the US economy out of the City of London banks.
Sure. So when Trump comes in office in 2017, he's got the opportunity to create a new Fed, to nominate a new Fed chair. Wall Street, which at that point his first term was dominated by Goldman Sachs, Steve Mnuchin and others were, and so it was really a Goldman Sachs administration. But they recommended to him Jerome Powell. Now, Powell, as we know from Danielle DiMartino Booth's expose on the Fed, her book, which everybody should read, we come to find out that Jerome Powell was one of the few members of the FOMC that was actually a hawk, was one of the few people who was against Ben Bernanke making the 2% inflation target the role of the new Fed mandate, along with its standard dual mandate of full stable prices and full employment. And Powell was extremely angry with all this, and never was never down with it. He was always at odds with the inflationistas like Janet Yellen and Bernanke himself. So when Trump comes to power, they recommend Jerome Powell. Trump takes their recommendation. Powell becomes Fed chair, and then he immediately starts trying to tighten monetary policy. Janet Yellen, again, when she was Fed chair, left us in a terrible position. She was doing QE. She was doing Operation
modern monetary theory.
Yeah, she was doing yield curve control. The Janet Yellen can be summed up in yield curve control. She's always trying to suppress the long end of the curve and support the short end of the curve. Like, she's always playing that game. And that's all.
And spend money like a drunken sailor and enable incredible spending on the fiscal side. Correct.
Agreed. Absolutely agreed. And so Powell, most of Powell's first term is him trying to begin the process of extricating us from that. But here's the problem. The problem is LIBOR was still in control. So really, the offshore European banks, the London banks, were really in control of our monetary policy. And on this point, for years, Jeff Snyder, when he worked for Alhambra Partners, before he started Eurodollar University, had made that point exceedingly clear. He did yeoman's work on this. I happen to disagree with Jeff now because he thinks that LIBOR is still somehow in control. I don't agree with him at all on that. But in 2017, the first thing that happens when Powell is confirmed is they pull this idea off the shelf that's been at the Fed as a white paper since the LIBOR scandal of 2008, which is we need to move away from LIBOR to the secured overnight financing rate, to some version thereof. So the Fed had already done a decade's worth of work on how this would be implemented. John Williams, who is the head over at the New York Fed, was the guy who was the champion of this. So Williams is moved immediately from the Atlanta Fed to the all important and all powerful New York Fed, and then SOFR is implemented immediately as a pilot project with a 5-year rollout plan from 2017 to full implementation of SOFR by January 1st of 2022. That's the history. And then SOFR is then rolled out in stages as various aspects of the domestic American markets are shifted away from LIBOR towards SOFR. But it's really when all American debt, all new debt, it doesn't matter what it is, a credit revolver, a car loan, a credit card, anything, it's all now indexed to SOFR and it's not indexed to LIBOR. So now we have the ability to decouple. We have the beginnings of the decoupling. Of course, the
New York Fed gets control, right?
The New York Fed gets control
of fixed income markets as opposed to London banks. Right.
Sure. Fair enough. And look, my libertarian / Austrian roots, I'm not crazy about that. We dealing with that, but that's still better than it being City of London, because we have fundamentally different rules for how capital is handled in the United States than they do in London. We can't infinitely rehypothecate.
Correct.
Okay, we can't do infinite rehypothecation of securities in New York.
For those who are not familiar with the word rehypothecation, which is a big, scary sounding word, to put that in layman's terms, you can create an infinite amount of money without any backing for it. That's what unlimited rehypothecation is. Right. This is the reason why Lehman Brothers had most of its 2008 derivatives exposures in London, not in the United States, because they could create an infinite. They had literally a perpetual money machine.
Right.
The problem is that when the dancing stops, and I'm mixing all kinds of metaphors here. Sure. Warren Buffett says, when the water goes out, you see who's swimming naked, and they were swimming naked and they failed. Sure. Right. But that's because they were enabled by the rules in the City of London to put infinite amounts of leverage in London.
Right. In effect, what they were allowed to do is they were allowed to take a security, pledge it as collateral, and then take 100% of that pledge. And then the person who has that contract as collateral can pledge 100% of the value of that contract against a different contract. So you could write a euro yen swap, then you could write a yen dollar swap, then you could write an insurance contract, and you could write this. And it's all built on the same little pile of money that was originally there, but there's all these derivatives. And then they sell it to us as well. The net value of all these derivative contracts is, $40 billion or $40 million, and it's not really that much money. Yeah, as long as everybody can pay.
And then when somebody doesn't, the daisy chain of defaults begins, and you get a financial crisis.
Well, and then
Yes.
what I always like to say is that there's the notional value of all of these derivatives, and then people talk about the notional value of these derivatives all day long, and they say, "Oh, $6 quadrillion worth of,"
Yeah.
like yeah, and the bankers will tell you that, well, it all norms out to like $40 billion. Yes, as long as everyone can pay, but notional becomes net when the other guy can't pay.
Correct.
That's the important problem. Like all of a sudden, it's well, you owe me, but I don't have the money. Well, go get it from that guy, and you got to go get, and you can't. And so the whole thing then just collapses. And then what happens then? The central bank is effectively being blackmailed into bailing everybody out. So the fundamental shift for the layman in the audience is that we move from an infinite rehypothecation system where there's no underlying collateral to all of these contracts to a secured system where someone has to post some amount of collateral, and that's it. And so there's a limit to how much leverage you can build into that system. And that limit is determined now not by London, but by New York.
And is it fundamentally more stable? Have we stabilized the financial system compared to what it was pre LIBOR? I mean, pre SOFR.
Let's fast forward to last week. Okay, I was just got off the phone with a patron who is very, very sophisticated, and because he's like worked in these markets, he was trying to explain to me actually what was going on. So in all the podcasts that I did last week, I identified what I thought was happening in the sovereign debt and currency markets when we heard, well, it was China selling treasuries, and because they were angry with Trump over the tariffs, and then we heard that the basis trade, the treasury market basis trade was blowing up. And then we heard that it was Japan that was selling because one of their pension funds was blowing up. And then we heard. But I'm looking at the market on Wednesday morning of last week, which is like April 9th. I'm looking at it and I'm like, the US bond market is off 20 basis points. The German bond market is flat. And the euro is up 5%. The Canadian dollar is up 5%. The British pound is up 5%. I'm like, oh, well, it's clearly what's happening here is that the selling is not coming out of China, it's coming out of Europe. It's coming out of London, Brussels, and Ottawa. And they're dumping treasuries onto the market. They're forcing the long end of our yield curve up because they've all gorged themselves on trillions of dollars since Powell's began tightening. They bought collectively over $1.1 trillion with the US Treasuries, all long dated stuff. We're not talking about T-bills here. We're talking about via the US Treasury International Capital Report. It's all long dated stuff. So it's all 5s and 7s and 10s and 30s. It's not 6-month T-bills. Okay. It's not 1 year. It's not 1 year notes. So what they did was they were selling the long end of the curve to push that up. And then when they sell that, the yield goes up, the price on the bond goes down, and then they can launder. Now they got to deal with that trade. So you sell a treasury, you buy dollars, you then sell the dollars and buy your local currency in order to convert your local currency into your local debt. If you want to try and cap the price on your debt, because if the U.S. market is selling off and everybody's worried about a recession and everybody's worried about this, the general market response is going to be sell all debt, sell all treasuries, and everybody get the cash. Sell equities, sell bonds, sell everything, because we're looking at a global recession/depression. Go to cash. So the tell was two things: the German bond market not moving at all.
Yep.
And which is the safe haven asset of Europe, and the euro rising sharply, which would be the biggest and deepest currency market in Europe, other than maybe the British pound. The British pound moved with the British gilt market, moved with the U.S. Treasury market, because it was already at a limit, a premium. Like gilts were already trading at such a spread to the United States market that it couldn't go any higher.
Okay, so why were those tells, and what's the significance?
Okay, so if you break it down, like I said, you sell treasuries, you buy dollars, you sell dollars, you buy euros, you then plow money into the German bund, right?
Yep.
So who's got enough treasuries to sell? China, the Chinese yuan didn't move at all. Chinese bond markets didn't move at all. the Japanese yen didn't really move. There was some buying of Japanese government bonds, so they were able to absorb any flows, any aftershocks in Japan. It would always show up in the currencies. The currencies were the tell, because the German bond market is big for Europe, but it's not big compared to the U.S. Treasury market. So you sell, for example, say you sell $50 billion worth of U.S. Treasuries in order to bomb the market. And then you start cascading effects of unwinding basis trades and SOFR swap trades and all this other weird stuff, all this other esoteric stuff that even the guys who trade it don't understand.
Yeah.
Right.
Yeah.
Literally. And then you're going to take that money and then you're going to wander it through that machine that I said, from treasuries to dollars, from dollars to euros, from euros to German bunds. But if you don't want to move the German bund too far without moving price, there's a limit that you can do to that. So there would be two tells. The two tells would be, in the central bank world, the currency rises. On the central bank or on the sovereign world,
so your
currency rises. And in the private markets that are trading in sympathy with this, gold goes ballistic.
Yeah, gold went ballistic.
And gold going ballistic makes perfect sense as well, because the guys are getting out of all these other trades and they're like, well, where am I going to go in this market? I don't know what the hell's going on. I'm going to gold.
But let's come back. Why is it significant that the euro rose and the German bund yields didn't move much?
That's indicative of who was doing the selling. Because who else would buy German bunds under this arrangement other than the European Central Bank or the Bank of England or I mean, no one else wants that debt, because on a daily basis, those markets themselves are constantly being manipulated. Christine Lagarde has yield curve control programs in place that she's been using for years. The German bond market has not been allowed. The German 10-year has not been allowed to go above 2.5% for any length of time for 4 years now.
So link this back to Trump. What's the significance to the U.S.?
Oh, sure. The significance to the U.S. is that what you're now trying to do is you're trying to signal to markets that Trump is breaking the world. The world doesn't want the chaos that Trump is engendering by selling the long end of the yield curve. It's feeding the narrative that Trump has breaking the world. And meanwhile, the German bund stays flat and everybody's like, see? And then literally Bloomberg writes an article and publishes an article that morning, same time this is all going on. It says, hey, if the U.S. Treasuries are no longer a safe haven asset, I shall present to you the German bund as an alternative. Right. It was literally, they were literally telling you what they were doing.
Yes, but now let's come back to, that's the story that Bloomberg wrote. Right. The real story, and you pointed this out in the podcast you referred to, is that the U.S. had no problem with the 10-year bond auction, which tells you there really wasn't underlying chaos in the market. Sure, you had some correction in the stock market, which obviously was overvalued and had run up too far. But they tried to create chaos. They tried to create a financial crisis, and they couldn't. Am I understanding your thesis correctly?
Yes, because look what did they do? They moved the U.S. 30-year from like 4.5% to 4.9%, and everybody else went, ooh, U.S. Treasuries are on sale. Buy. And they went and they bought. And then we had a stellar 10-year auction that day. Yep. We had a stellar 30-year auction the next day. And by the way, we had a stellar 20-year auction on Monday.
So Scott Bessent won. Is that your conclusion?
Yes, that would be my thesis.
Battle.
Yeah. What's that?
Won this battle.
Yeah, absolutely. I think he won ultimately. And then in my discussion with my patron this afternoon, in preparation, by the way, for this conversation, he was telling me, he pinged me a couple of days ago. And he said, the real inciting incident for all this, he's like, Tom, I think you're correct about all of this, but that's not the inciting incident of the story. That's kind of like in movie speak, that's plot point number one, or that's the middle of act one through act three. The inciting incident was that, because there was no real movement in the basis trades. It was all in the SOFR. It was all in the SOFR swap trades. And Zero Hedge even noted that in the article.
Yes, they did.
Down this road. So what was happening is that these guys were all long U.S. Treasuries, and they were short in the SOFR, and they were short the SOFR futures curve all the way out, from like 6 months out to 3 years out. say they were long US Treasuries on the 3-year market, and then they were short how he put it, the strip from across the entire SOFR futures curve. And if you go back in, and you can do this, you can go to the CME's website and you can go look at SOFR futures curves. I have that thing bookmarked. As a matter of fact, I have a tab of the SOFR futures curve open in Opera 24/7 on every computer in my house and my iPad. It's there because I look at it all the time. And you can go in and you can go look at the trading data, and you can see it on those days, the size and volume of the trading bars. I was looking at like a 2-hour chart. So, or 1 and a 2-hour chart. And I was looking at the intraday market action, and it was crazy what was happening. It was, the SOFR market, if it moves 5 basis points in a day, that's a lot.
It's huge. Right. Yeah. Because of the trillions tied to it. Yeah.
3 basis points is 2 to 3 basis points is a normal day. 5 basis points would then be a 2 sigma day, and 40 basis points is a 12 sigma day.
Yeah.
In mathematics.
And terms. And what did we have last week?
And we had something like that. We had 1-hour bars that were literally 20 and 30 basis points, and they were all timed with either the New York Open, the European close, they were attacking at different times. They were attacking on the Sydney Open at 5 p.m. New York time, or 6 p.m. New York time. They were attacking at 3 a.m., which is the opening in London. They were attacking at 11 o'clock, which is the close in Europe. They were attacking it in different days, and you can watch a crescendo over the course of a week. It started a couple of days before that, and then it reached its peak on April 9th, and then it's fallen off since then. And over the last couple of days, the SOFR futures market has been
stabilized,
kind of quiet, and so has the U.S. Treasury market.
So, okay, so the aha of all this is that this is a culmination and an actual break of the U.S. financial system being controlled by London banks and by the European Central Bank and the Bank of England, and the U.S. has now wrested control of its fixed income market back definitively. Is that your conclusion?
No, it is not. What it is telling you that we have now defined who the real enemies are. Now I'm going to take you back to September 2019, when we had the SOFR crisis of 2019, when SOFR was in a liquid market, and SOFR blew out to like 11% or something on the day. And that forced the Fed to come in, reopen the standing repo facility for U.S. banks.
The standing repo,
came in, and they did, and we had our repo crisis of 2019.
Yeah.
And that is also very similar, by the way, to the repo crisis of 2007. And at the time, I don't know if you and I were speaking back then, but
no,
when I was watching that play out in September 2019, I said, well, if it echoes what happened in 2007, 6 months from now, we're going to have a real financial crisis in the United States, because that's what happened in 2007. We had a repo crisis. By March of 2008, Bear Stearns vaporized.
It failed.
As the commodity markets moved against their bets, and Bear Stearns was gone. 6 months after that, we had Lehman Brothers. So now, in September 2019, the Fed comes in, stabilizes the market. We had a SOFR crisis. And in March of 2020,
what did 2020 crash? Right.
And the Treasury market goes bidless, and the Fed is forced back to the zero bound.
Right. And it all got blamed on COVID, but you're saying that there were deeper financial plumbing implications. Are you predicting that 6 months from now we're going to have a repeat? Or because it was more stable this time, this was not actually a battle?
What I'm saying now is, we have if history repeats and rhymes, then is this the inciting incident? And are we going to have a bigger one 3 to 6 months from now? Remember, in this one, though, in 2007, we lost Bear Stearns, and the Lehman Brothers had the worst financial crisis since the Great Depression. In March of 2020, they had to dump COVID on us. They had to halve the price of oil over a weekend, from Friday's close to Monday's open, where oil went from $80 a barrel and then opened to $40 and blew the markets open.
Right.
Okay. And took down the world. This time, the Fed didn't even have to come in and do anything.
Right. But to the earlier point, yes, okay, equity markets have had a correction. They were overdone.
Sure.
The rest of the market hasn't actually had that big of a correction. There are pockets of it, of course.
course.
But the perception, if you read the headline, is that the world's falling apart.
Right.
Correct. But that's
Correct.
not the reality when you look at the market internals.
That's what I would, that's the way I would put it. And then if you're Europe, if you're, let's just call a spade a spade. If you're the Rothschilds and you still want to control the world from behind the scenes, not that I'm a big fan of the whole Rothschild narrative,
tinfoil hat.
I'm not a big fan of that, but I think they're players in this.
That's a proxy for that tinfoil hat theory is a proxy for Europe.
Of course, it's a proxy for the old colonial banks of Europe that have been, moving markets for 500 years
and had control of U.S. interest rates literally until March.
Yeah, exactly. Now, here's the big question. If you're them, right, and you're staring at Trump remaking the entire global financial system based on going back to lower leverage, tariffs, lower income taxes, and everything else, and literally starting the process of breaking the world up into currency blocks and potentially even, oh my God, having an actual, hard asset-backed currency system of one form or another. Not today, not tomorrow, but let's say 5 or 10 years.
There.
Right, heading in that direction. If this is that inflection point, would you not set off every financial nuclear weapon to try and stop that?
If you're Europe.
Yeah, if you're Europe. Motive means an opportunity. All I'm doing is acting like Columbo here. I even have the cigar. I even have the cheap cigar.
And they've got the financial press, right? Because the financial press in particular is very anti-Trump. But what is interesting about the existing market backdrop is just how steady a hand Scott Bessent has proven under pressure. And there are two things that I wanted to ask you about and shift the discussion a little bit, because you haven't talked yet about the change that we now know is coming in the supplemental leverage ratio and the impact that that's going to have on the US Treasury market. And then I also wanted to talk about the fact that the stablecoin bill is creating a dichotomy between offshore US dollar stablecoins and onshore US dollar stablecoins. And I believe this is the first time that the US will officially sanction a difference between the offshore dollar and the onshore dollar. Let's start with the supplemental leverage ratio first.
This is really fascinating, because this is actually, I would actually really rather hear what you have to say about this, because I've only just started to dive into this. So it's two things. The stablecoin bill is incredibly important. I just read a Standard Chartered report on it this morning. As a matter of fact, I had a friend of mine send it to me, and the supplemental leverage ratio, which I don't quite understand, was actually noted by my patron that I discussed all the SOFR basis, the SOFR swap trade this morning. So I'm happy to throw that back. I'm smart. I'm happy to throw it back to you on this, to have you talk about it, and then we'll go from there. One other thing I want to add to this discussion when we get there, which is, isn't the U.S. moving towards central clearing of all U.S. Treasury trades?
It is, which is taking some of the dealer balance sheet constraints out of the Treasury market as an attempt to increase the liquidity and daily functioning of the Treasury market, and take the Fed's balance sheet out of having such a significant role in it. But here's the aha. Just in the past 2 days, even since I listened to your podcasts, it has been confirmed. Even I think yesterday, Powell confirmed it during the speech he made, that they are going to be relieving the supplemental leverage ratio. That, I started a bank, I come from investment banking and capital markets background, and also Austrian background, Austrian School of Economics background. Okay. To me, it has never made sense that the banks had to hold capital against what is deemed to be in this current financial system the risk-free asset. You and I both agree it's not a risk-free asset. The U.S., of course, has default risk, but we call it a risk-free asset in air quotes. And those, actually, the risk-free asset is really the different side of the same coin, which is a deposit, a bank reserve held at the Federal Reserve is risk-free, because it's dollars held at the core of the financial system, and where the Fed can just print more in order to make sure it never defaults. And the U.S. Treasury, Martin Armstrong was the one who got me to see this maybe 15 years ago, that
Mm.
The US Treasury is just a dollar that pays interest. It's the same thing,
Right.
and except it's an interest-bearing dollar. That's all.
Right.
So it's really, again, different side of the same coin. It doesn't have credit risk. So the notion that the banks had to hold capital against this at all
Oh, yeah, yeah.
always, to me, was an anathema. If the Fed and the capital setters of the banks wanted to reduce the leverage on the bank's balance sheet for the things like infinite rehypothecation that we just talked about a few minutes ago that they can do in London, if they really wanted to fix that, putting a capital requirement on a risk-free asset made no sense to me ever at all. And so it was that supplemental leverage ratio during the repo market hiccup and the March 2020 correction, the crash,
Mm-hmm.
were the Fed stepped in with its balance sheet, but also they temporarily removed the supplemental leverage ratio, which was a capital requirement that banks had to have. And then there's the enhanced supplemental leverage ratio for the largest banks in the world.
Mm-hmm.
Okay, so here's what's going to happen. Powell and Governor Bowman and multiple Fed governors have said in very recent days, this is going to change. So now you get these giant bank balance sheets in the United States that have so far had to hold capital against treasuries. And what do people have in market runs at treasuries, right? We saw huge rallies in treasuries. Banks own a lot of those because they pretty much have had to own a lot of those. Mm-hmm. And especially the regional banks went and loaded up on them during COVID when the Fed flooded the field with all this new money and told everyone that inflation was transitory. What did all these community and regional banks do? They went and bought long-term treasuries so they didn't have to hold capital against them. They weren't subject to the supplementary leverage ratio as a constraint on their balance sheets. So their attitude was, hey, let's just clip the coupons, take a little interest rate risk, but the Fed will always backstop us on that. And then lo and behold, the Fed raised rates and they got whipsawed. And now it's something like 300 billion of unrealized losses in the small and medium-sized banks in their treasury portfolios. But the Fed has not really cracked down on those. We obviously saw some of the banks that got them that rolled that dice and played the maturity transformation mismatch game fail in the spring of 2023. But the bigger aha is that the banks are loaded to the gills with these treasuries and they don't have capital, especially the large banks. The dealers don't have balance sheet capacity to increase their intermediation in the treasury market. And there's an obvious way to bring a new buyer into the treasury market, and it is to relieve a supplemental leverage ratio. And I believe that a lot of the fixed income market rally has been front running that trade. And you will see more front running that trade as you start to, now that I'm putting you on this, as you start to hear Fed governors talking about it, you will see even more front running that trade. But Tom, this is a big deal because the euro dollar market and foreign buyers that are reported through the tick report that you've referred to, where you're tracking the offshore buyers of treasuries, and you realize China's not as big as everyone thinks, but the banks are. And they're about to have a lot of treasury buying capacity unleashed. This is one of the tools that Scott Bessent has to support the U.S. Treasury market. And it's an important one. Now, how he sequences this, it is huge. How he sequences this and how, at what's the time period? Is it all at once? He can't do it all at once because then there'd just be this rush to treasuries, right? So I think the details are really going to matter on that. But my point is, of course, the U.S. Treasury market isn't going to come unglued because you have this huge guaranteed buyer that is right now constrained, that's about to have its capital requirement relieved. And the Fed has control over the timing of that.
That's fascinating and that's awesome. And I'm so glad you went through it because I had no idea about any of that.
Yeah,
so
and it's another big piece of this.
I really appreciate that. So now I'm going to throw something else.
Shot their wad too soon.
Yeah, but what a shock. 2 days, it started 2 days after synthetic LIBOR ended. And Trump, I think Trump decided that Liberation Day would be April 2nd for a reason.
Interesting.
Yeah,
I had not made that connection
because
before.
remember now that
Because LIBOR
synthetic
ended March
LIBOR is
31st.
over,
Yeah,
now they
yeah.
have
The
to go
synthetic
and they got
LIBOR.
to
Yeah,
go get
yeah,
collateral.
yeah, yeah, yeah. They've got to go
And
get
they got to use
collateral. Yeah,
bank reserves to pledge.
yep,
They got to use treasuries as bank reserves to go pledge as collateral to get access to the U.S. repo market. And they got to pay our rates for it. And they got to come to
correct.
the Fed or they got to come to U.S. banks who are going to charge them SOFR for it.
Right.
So
And they've
this
got
is
to
why,
post the actual collateral.
and they have to
That's the
post
point.
actual collateral.
Yeah,
Yes.
yeah,
So
yeah.
now it's
Which is
a
a T bill or a treasury bond, et cetera, et cetera.
sure
Yeah,
something along those
yeah,
lines.
yeah.
And these are assets that they were using as reserves to offset their savings. Now you know why the European Union is talking about how do we mobilize the savings, or more appropriately, how do we confiscate the savings so we can free our banks from having to keep all these assets as reserves.
Yeah.
This is, I think, part of the other part of the story. And
Let's
again,
talk
now
a little
you're,
bit about offshore dollars. Oh, sorry. Go ahead.
but no, because I want to bring something else in here, which is Basel III.
Yes.
Jamie Dimon has complained bitterly about Basel III. I have heard from a number of different people that Basel III in the United States is dead. And the reason why Basel III is evil from an American bank perspective is that it's asking American banks to hold something like 30% more capital than European banks as excess reserves in order to make sure that we don't have a systemic problem. And Diamond's like, absolutely no, you're disadvantaging us. And does that tie? I don't. Maybe I
Yeah,
don't
it
understand.
does.
Does that tie
Well,
right into the SLR? The
well, because
or am I
it would have been in addition to the SLR.
right? Right. So
Yeah, yeah, yeah.
crunch.
So
Fuck
exactly,
me.
it was a big increase in capital. Again,
Mhm.
my point though is it was fighting the last war. It was fighting the wrong war. If
Right.
you want to reduce leverage in the GSIBs, which I think is a valid goal, I've always
Sure.
thought the financial system is too leveraged. It's
Agreed.
fundamentally unstable.
Hmm.
And especially now with technology increasing the speed of capital turnover, right? We're
Yes.
reducing settlement cycles. You don't have as much fault tolerance from an operational systems point of view, um, because your settlement cycles are speeding up, and your return on capital as a result of speeding up your settlement cycles should increase, but your risk of problems also goes up because you
Right.
just don't have that fault tolerance of, hey, I can solve this tomorrow, um,
Right.
in the system. Okay. And so everybody's going to have to deleverage anyway.
Hmm.
But how do you do it? Do you do these crazy things like putting the E supplemental leverage ratio requirement, capital requirement on a risk-free asset, or do you actually get to the real sources of risk in the system, which is
Right.
all the leverage and credit risk and interest rate risk? I
Right.
would much prefer to see it done with the latter. It was a blunt instrument. It was designed, ironically, to try to reduce the size of the big banks. But what happened during the Biden administration to the big banks? They got bigger. Um,
Bigger. Yeah. Yep.
yeah. So it actually, as with so many government policies, the
Hmm.
intention is good, but the actual outcome is the opposite of what was intended. And they handed First Republic to Jamie Dimon by giving him an exception to the 10% limit on deposits. JP Morgan Chase has now more than 10% of the US deposit market.
Right.
And they gave him an exemption to be able to buy First Republic. There's a lot of smoke around those four bank failures from the spring of 2023, that there
Hmm.
were shenanigans in every one of them.
Yes.
And one of the eyebrow raising things was how First Republic was handled, and why Jamie Dimon was able to get the exception to the 10% deposit limit. I digress. But look at the outcome. The big banks got bigger, and the medium-sized banks got squeezed. And that was not what the intention of the bank regulators was. I digress. But what they were trying
Well, no,
to do with Basel.
I want to stop you there for a second because
Okay.
I live in a world that's far more cynical than that. I'm sorry.
Okay.
I
Fire
just
away.
I look at that. I say to myself that looks like a bug, but it may have been a feature.
Well, are you saying Elizabeth Warren and the Warrenites are actually big bank defenders? No,
I not
I'm
yes, but
saying
not
that.
but
I'm
yeah
saying
yeah
that
yeah. No, I'm not.
sarcastically,
What
right? Because
I
she
know you
had
are.
total control of the
Of course
Biden
she did.
financial regulators, right?
Of course she did, and
It's
she
now not even a secret. It was an open secret for a while, but it's not even a
exactly.
secret anymore. That even the financial historians are coming out and acknowledging she was the de facto president of the United States on these matters. She had
Yes.
total control
Yeah.
over financial and economic policy. Biden ceded that to her. It was a
Yeah.
deal the two of them made when she dropped out of the 2020 presidential race and
Hmm.
endorsed Biden. So, okay, so the funny thing is they say they don't want the big banks to get bigger. And your point is that may have been actually what they wanted.
Or that I don't even believe in any way, manner, shape, or form that Elizabeth Warren works for the United States. I don't think she even works for the big banks on Wall Street. I think she works for some. I think she
Europe.
works for. I think she works for Europe. I think she works for
Yeah.
City of London. I think she works for Brussels and Davos and all the rest of those people. Everything about her everything about what she does
Yeah.
that screams that, and that any way that you can create a so I look at like First Republic, for example. I know we're digressing away from where we wanted to go, but I mean, there comes a point, and I'm not saying that I believe this, I'm just like going to throw it out there, which is that maybe we had to deal with those four banks in the way that they did, and they had to break some rules in order to break some of the other funding cycles that were happening that we don't even know about. You know, you and I talked during that we did a podcast during the blow up of Silicon Valley and Signature Bank and all of that.
Yes.
We talked about all of this, and I thought that those were public executions by the Federal Reserve in order to break the San Francisco Fed's a challenge to the
You
New
said
York
that.
Fed's dominance. And
Yeah.
I think, and I still stand by that, but I'm, happy to be wrong about it. And if we were
Well,
to go back and look at it, but because I don't trust Mary Daly at all. I don't trust Janet Yellen. I don't trust any of these freaking people because
that came from San Francisco.
clearly
Yeah.
there's something going on there. And then there's probably a China angle that nobody even freaking knows about.
But let me throw you a curveball though.
Sure.
I don't know if you saw Nick Carter's Pirate Wires article. I'm
Mm.
told by DC insiders there wasn't anything new in it, but there was a lot new to me. And
Okay.
Nick was able to get people to talk. And he said, listen, yes, there was a lot of desire to kill crypto, which is why they wanted to kill the crypto banks. But what was really going on was Silicon Valley Bank had the bank run. It was triggered by the Fed forcing Silvergate to quote unquote voluntarily liquidate. And the next day, everybody was like, oh my God, look at the balance sheets of these banks.
Right.
They have huge unrealized losses in these treasury portfolios that we just talked about, that they were because of all the money that was flooded into the banking system during COVID. It had to go somewhere.
Right.
And there were the short-term treasuries paid zero yield. And so the bonds, so the banks went and bought long bonds. They invested in 10-year bonds.
They had to.
Because they had no capital charge. Again, they weren't subject to the supplemental leverage ratio. That was not their constraint. Right. And as a result, they didn't have to hold capital against it, and they could clip the coupons and take the yield. The problem, and they were looking at the Fed, wink, wink, nod, nodding, saying, this is where the money should go. And then they got rug pulled by the Fed raising rates. And all of a sudden, they had huge unrealized losses. And that's not a problem if the bank stays liquid. But if there's a bank run, oops. And that's what happened. Okay. And that happened at Silicon Valley. But here's what Nick's report said that was enlightening and I think plausible. That Silicon Valley was failing. You had all these Silicon Valley startups that had all of their corporate cash on deposit at Silicon Valley Bank.
Right.
And they were going to go under. Nancy Pelosi made a phone call on that Friday of Silicon Valley Bank run, and she made a phone call to the White House, begging the White House to guarantee all uninsured deposits. In other words, there was not going to be a cap of $250,000 that most of us operate under, where the FDIC insures up to $250,000. She wanted every uninsured deposit to be capped. The problem was, this was a San Francisco power play over New York.
Right.
And what happened? In order to justify invoking the systemic risk exception the Fed needed a New York body to counter the San Francisco body. And they took down Signature Bank on that Sunday. For those who are in the banking world, that is extraordinarily rare because banks go down on Fridays. Yeah. And the FDIC comes in and sells them. And then they open first thing on Monday morning with a new owner and all the deposits, the $250,000 deposits guaranteed. And then everybody else is supposed to take a haircut. Well, that's not what they did with Silicon Valley Bank. But in order to justify paying off 100 cents on the dollar to uninsured depositors, they needed a scalp in New York. And that was what enabled them to invoke the systemic risk exception. And Barney Frank was screaming at the time and screaming even louder now that that bank was solvent, that bank was liquid, that bank was shot. Signature Bank was shot on purpose by the Fed, he alleges, and he even talks about how he called Jay Powell, Barney Frank, as a director of Signature Bank, called Jay Powell. Jay Powell said, you got to talk to Michael Barr, the vice chair for supervision. Barney Frank said, I talked to Barr. Barr said, I'm on it. I'll call you back. And then Barr never called Barney Frank back that night. And that was Friday night. Signature had collateral parked at the Federal Home Loan Bank. They just needed, he said, Barney Frank said, they just needed a tri-party agreement to be able to move their collateral from the Federal Home Loan Bank to the Fed discount window. And the Fed wouldn't call him back. And so they just started moving collateral and the Fed kept rejecting it.
Wow.
These banks were shot on purpose, is the allegation. And there's an awful lot of smoke. I said there've been allegations for a while that that the whole thing started with the desire to take crypto down. And it came out in lawsuit filings that the Fed pressured Silvergate after it had survived a bank run. Everyone thought Silvergate went down because of a bank run. No, it survived the bank run. And then the Fed came in and pressured it and they voluntarily, in air quotes, shut down. And the next day, with all that jitteriness, the Silicon Valley Bank run began. And in order to justify invoking the systemic risk exception to bail out not just Nancy Pelosi, but her husband's business, because he had a mezzanine lending business. Nick goes through all of this, right? And it would have gone bust, he alleges, had Silicon Valley Bank not been bailed out. And he points out that Silicon Valley Bank and Silicon Valley itself is Ro Khanna's congressional district, not Nancy Pelosi's, but she was the one allegedly who made the call to the White House. So yes, there is an awful lot. And by the way, now let's move forward to where we are today. Last week, Governor Bowman, who is Trump's nominee to replace Michael Barr, who was obviously playing ball with the Warren crowd. Again, remember, in order to get a job, a political appointment job in the Biden administration, Warren controlled it all, right? So who was she? Who were all these folks reporting to? It was her, Warren. So now Trump has nominated Bowman. Bowman dissented from the Fed's self-assessment of its performance during the spring 2023 bank run crisis. They, within 90 days, put out a self-assessment and it was voted on by the Board of Governors. Bowman she took the gloves off. Steve Kelly from Yale tweeted about this at the time, that Bowman really took the gloves off because she said this was a self-serving self-assessment by the people who made the very mistakes that they were supposed to self-assess, and that the other Fed governors did not have access to the information and were not able to comment on the report and were asked to vote it through. And she dissented because of that.
Sure.
Now that speaks volumes about what really happened inside the Fed, how siloed information was. Keep in mind, my company was dealing with some of these very same people who were trying to kill us, literally, during that time, right? So anyway, she announced that she will be reopening that. She said that she will be examining whether the skill set matches the needs of the current market, and that she will be re-examining the whole supervision and regulation apparatus at the Fed. Now, breadcrumbs. Scott Bessent at Treasury has been saying we need to restructure supervision and regulation, right?
I was just about to say.
Right. Banks are bristling under this supplemental leverage ratio, the big banks especially, but not just the GSIBs, the regionals too, bristling under that balance sheet constraint, you can see where the deal is coming here. It's obvious where it's coming. Right. And the banks are going to get capital relief. That's going to be good for treasury markets. That's going to help Scott Bessent in what he very clearly wants to do, and he keeps talking about, is getting the 10-year down, because that puts money in people's 10-year treasury yield. That puts money in people's pockets, in Main Street's pockets, not Wall Street. Yeah. So yes, big. You should read Nick Carter's Pirate Wires article, and I just gave you the bulk of it, but it was all about justifying invoking the systemic risk exception to be able to bail out the Silicon Valley depositors.
Excellent. Do me a favor and send me a link to the article, so I'll put it in the show notes for the podcast.
Yes, I will do so.
Yeah, I'll read it and then let everybody else do it. Yeah, just throw it in the chat and we'll take care of it.
Let's go to stablecoin bill next.
So the stablecoin bill is fascinating as well. So now, so episode 213, Caitlin Long takes over the podcast. That's what which I adore. I think it's fantastic. I'm so happy. Like, you're so
we always end up doing
this. Are you kidding me? Like, this is phenomenal. I'm so
keying
very
off
happy.
each other and teaching each other.
It's all good. It's all good. I say that with the most amount of respect and love. It's been great.
Of course.
So with that said, let's talk about the stablecoin thing, because I've been saying for a long time now. Like, I just read the article, or the research note from Standard Chartered, and they're talking about a probable 10x expansion of the stablecoin market. Now,
at least
now let's talk about what I've been saying about Tether for a long time, and I don't think it's a hard argument to make, which is that, and certainly USD coin works the same way, which is that they have to hold, they affect the kind of like hot money sink, or the heat sink, for short-term treasuries. Like, they are for short-term treasury demand, especially against Bitcoin. So trading against Bitcoin. So if they're talking now about a massive expansion thereof of the stablecoin market, because you're starting to see even more, if I'm picking up what you're laying down, an even bigger argument for why we have now fully decoupled effectively the way the financial system in the United States operates relative to the way dollars are priced around the world versus who's actually in control of that. So why don't you take it from there, and we'll go with that.
Well, and what I introduced is that the stablecoin bill is going to create, for the first time, a endorsed differential between an offshore dollar and an onshore dollar. Right. The Fed, particularly because of the control of the European banks on the Eurodollar market. What is a Eurodollar? Let's go back. It goes back to the 1950s, when Russia didn't want to hold, during the Cold War, its dollars in a U.S. bank because it was afraid they'd be confiscated. So it got the European banks to agree to take U.S. dollar deposits. So there was this huge offshore market, which is actually as big, if not bigger, than the onshore U.S. dollar market. It is big. And to your point, it hasn't been in control of the Fed. Well, the Fed is now wrested control over interest rates. The most important interest rate was, until recently, LIBOR. It's now SOFR. And it used to be unsecured, priced in London. It's now secured, priced in New York. Okay, now here comes Tether. Tether is a company that, for all the allegations around it related to money laundering, et cetera, the Biden administration did not shut it down. Let's stipulate that is a fact. It could have, in theory, especially when it was disclosed that it wasn't just a broker-dealer in the United States that was holding its U.S. dollar reserves. It's a primary dealer. It's Cantor Fitzgerald. Okay, one of the 24 primary dealers of the U.S. Treasury market is holding Tether's treasuries. So obviously there's a U.S. nexus. The Biden administration could have shut it down if it wanted to, and it did not. Okay, frankly, I think it's not difficult to make the logical leap as to why it didn't, because the CEO has now been talking about openly how much they're working with U.S. law enforcement, and three-letter agencies are all onboarded. So the long story short is there's a foreign policy reason why Tether exists offshore. Now, what's fascinating to me is that Congress is about to ensconce this by saying, okay, you can be an offshore issuer, and you don't have to do all the same know your customer and anti-money laundering rules, particularly that a bank has to do. Bank has to do something called CIP. up front. You have to, before you onboard a customer to a bank, you have to do all the know your customer and enhanced customer information program up front. Fintechs don't have to do that, and Lord knows an offshore company does not. Okay, so let's also stipulate that banks have the highest level of compliance on that. Fintechs less so, although officially they're subject to the same rules, but we know in practice they're not. Right. And then offshore, again, they say they're subject to all the same rules, but again, we know in practice they're not. Okay, so there's three layers. What is Congress doing? They're saying, yeah, those offshore guys, we don't want to shut them down. We're going to keep it just as is. So what is Congress doing? They're creating an incentive for stablecoin issuers to leave the United States and to go offshore, right? Now, is this something, I don't know what Bessent thinks about this. And obviously there's the Bessent-Lutnick friction, shall we say, that's been reported multiple times within the administration. Bessent controls FinCEN, which would be the regulatory arm, and the IRS, which would be the regulatory arm of a crackdown if it were to come on those offshore stablecoin issuers. And Lutnick obviously had the connection, no longer officially connected to his firm, Howard, to Cantor Fitzgerald. Right. So you see that axis right there. I don't know how this is going to play out, but right now, the way the stablecoin bill is drafted, and it's pretty close to done, is that there is that offshore stablecoin issuers do not have the same requirements as onshore. Now, let's stop and think about what that means for the US dollar. Because we've created a two-tier system, and a two-tier system on all these financial crimes compliance requirements. Or I would argue there's a three-tier system: banks, fintechs, offshore. Lowest requirements offshore. Is that going to stay in place? The whole idea is Tether. When Paolo Arduino talks on podcasts about how that has created incredible resilience for the US dollar, because Tether is pushing the US dollar out into emerging markets, down to the communities that nobody has banked before because nobody could figure out how to bank them. And those communities bank them profitably. And those communities, Tether did. Hats off to them for doing that. Those communities have access to the US dollar for the first time. And in most of those emerging markets, they would much rather have a US dollar than their own local currency. And Tether has built this distribution channel, and there is nobody competing with them. And they're pushing the US dollar out into the distribution channel, and they're recycling those tiny amounts of money from working class in emerging markets. And I think they have 400 million users. It's a stunning number of users. They're the biggest financial company in the world right now, and just keep getting bigger. And they are recycling all of those flows back into the US Treasury market. What is that doing? Because those are not going to be panic sellers. No. What is that doing? That is increasing the resilience of the US Treasury market. Yeah. So he's right when he says that this is actually, there's a strategic value to the United States for this. But now let's step back. We've got these onshore issuers who are trying to be regulated and break their way into the banking industry, and Custodia is one of those. And then we've got these offshore issuers. And there is a difference in regulation between the two. But let's talk about it for vis-a-vis the US dollar. The way that the Fed kept par. Zoltan Polznar talks about this all the time, that par is the most important price of money. That is ultimately the value of having a clearing account at a central bank, is that you get a par guarantee on the currency. Right. Par is what the central banks enforce. Why did the Fed put swap lines with other foreign central banks? To be able to enforce par in the Eurodollar market. Now, we've just created a new Eurodollar market called stablecoins, and there's not going to be an enforcement of par because there isn't going to be a swap line infrastructure set up to enforce par. What is the significance of that?
I've been absorbing everything you've been saying. I'm going to plead the fifth on this one, Caitlin. I am, because I'm not sure what this implies. I'm not going to be able to going to try and fake it to make it here. I don't know.
I'm not sure that anybody knows. And I will, that's okay. I'm okay because I don't know the answer. That's why I kicked it over to you. But
Right.
what I will say is there are entire green fields for stablecoins. A lot of
Right.
people think crypto doesn't have any use. I'll tell you the biggest reason. And by the way, Tether created the killer use case, which is for the US dollar. And a
Right.
lot of people look at it and say, why do you need a blockchain for that? That's an inefficient database. Yes, of course, it's an inefficient database. But what were they able to do? Create incredible network effects by
Mm-hmm.
having 400 million users globally. That's
Right.
bigger than the United States,
Yes, it is.
right? Okay,
Right.
in population, right? Okay, so now incredible network effects. That's what we're tapping into. What are the green fields? The biggest one is putting that into the regulated banking industry.
Mm-hmm.
Everybody right now is forced into FedWire, ACH, and a little bit of FedNow, but that was such a controlled, closed system that it hasn't really taken off. FedWire and ACH, hell, stable coins are faster, cheaper, more auditable, more programmable,
Mm-hmm.
safer from an IT security perspective, I would argue,
Right.
for a whole host of reasons. This is a game changer to
Yes,
push that into the green field of the traditional banking system, which is what Custodia just did. But it's more than just that. Paolo Arduino also talks about machine to machine payments. We are going to have our Optimus robots paying our Teslas, going and filling up our Teslas, right?
Right.
Without human intervention. Somebody's got to figure out how to pay. That is not going to be FedWire and ACH. That is going to be these digitally native forms of the US dollar. And that is also a greenfield. Tom, these are huge market opportunities.
No.
The world's going to change.
No. You're absolutely right. I'm beginning to catch up to you. You have fired at me like an unbelievable amount of stuff, and I'm eternally grateful for it. Don't get me wrong, but I'm beginning to find. Because in all of that, I'm trying to absorb all of this. Now let's go back and let's ask what I have to go back to first principles for me. Ready? Which is what current currency settles 30% of the world's forex?
30%? It's more than the US dollar.
It's the British pound.
Aha, okay. Right. And nobody wants pound stablecoins.
Bingo.
By the way, the Bank of England made a stupid decision to say that stablecoin issuers, pound stablecoin issuers, had to charge fees and couldn't earn interest.
Right.
What does that guarantee? It violates that
enforcing a par.
Price par. Exactly.
Right. It's the dumbest thing imaginable. So
correct.
I from the beginning, like all of this stuff I've been saying, I didn't really believe that Donald Trump, when he was coming into office, had any real understanding. And I still don't think Trump understands a lot of 90% of what we just discussed.
But he's got people around him who absolutely
he has
do,
people around him,
especially Scott Bessent. Yes,
exactly that. But he understands at the 30,000 foot level who the real enemy is, and he's poked that snake over and over and over and over again. Europe and City of London, and the City of London's Achilles heel is that they want to protect that egregious advantage of having the ability to settle and collect fees for the world's forex, because those are truly the biggest markets in the world. We talk about the Treasury market being big. We talk about the U.S. equity market being slightly smaller. Yeah. Oh no, it's all forex, baby. On a daily basis, it's an insanely large thing. Correct. So watching Bessent and company and Trump come out and bless things like Ripple. And what he's saying is we're going to have control over these stable coins. They're going to be U.S. and we're going to give preferential treatment to the ones that we deem made in the USA, for lack of a better term. Yep. And we're going to use that as a means by which we can now program them to say, yes, as you just said, we can now take that business away from London, who've also, by the way, shot themselves in the foot from their other major business, which is ensuring the shipping around the world.
Correct.
They make most of their freaking money. What do you think?
Yeah.
Like they've already destroyed that. The Russians and the Iranians the Russians are going to have their own,
but they shot themselves in the foot on this stablecoin piece too.
I agreed, because
and Tether left Europe. Why bother? It's 99% dollars anyway.
Exactly. So and moreover, on top of all of this, if you go back to what you touched on earlier, which we didn't really get a chance to talk about, and because you fire hosed a whole bunch of really good stuff at us. Bessent and Powell have lunch every Monday, right? They're having lunch. Bessent came out the other day. He said, "Do you talk to the Fed chairman?" He's like, "Yeah, we have lunch every Monday." This week it was an away game. I went to visit him.
Okay.
I went to visit him, and he,
I didn't hear that.
And every other week they trade back and forth. So they're clearly talking and coordinating.
Good. That's good. I did not know that. That's great because Powell had said he hadn't talked to Trump.
Right. He doesn't talk to Trump, but he talks to Bessent. That's all that's necessary. So there's a fundamental difference between Powell and Yellen where they didn't talk at all.
Well, they were at each other's throat.
Exactly.
Right. Yellen was trying to do QE through the Treasury General account and
on behalf
making
of
Powell's job a lot harder.
And left all of them with $8.9 trillion, which need to be rolled over in the
next Lordy, yeah.
We don't even want to get into that. So clearly,
but we just laid out some places though, Tom, where it's not going to be difficult for Bessent to create some of that buying demand. Right?
I agree.
At the right time.
I agreed. But the thing that's important here is that what I've been positing for a while is that in order to finish they have a plan to recapitalize the United States. And I think they want to create a domestic dollar that is backed differently than the offshore dollar. And I think that
that's what the stablecoin bill is going to do.
That's where I'm going with this. And at the same time, fork the Forex business off from City of London, control it. If City of London wants to move stuff around, in British pounds, you go right ahead. But what the Bank of England is doing is they're being subsumed into the ECB. Clearly, that's what's happening here.
Yes,
is that there's a move now to consolidate power in Brussels and finish liquidating what's left of England. And in a 40,000, one of the things we didn't discuss in the 40,000 foot overview of where I think the world is, because as we opened the podcast, which is that I firmly do believe that Trump is making geopolitical moves to say, okay, it's time to fully decouple us and to save not just the United States, but all the members of the Commonwealth. That includes Canada, that includes the Little Britain, what's been left behind. And by extension, if you break the European Union in the process, then you also free maybe even against their will, you free most of Europe. We're doing this podcast on April 17th. Who is in Washington right now discussing a bilateral trade deal?
Right. And you made this point last week. Yeah, that Trump is trying to break the EU stranglehold over tariff policy and trade by cutting bilateral deals with each of the European countries
and
directly. And Maloney's playing ball.
Yeah, and literally saying, I'm not negotiating with the European Union because I don't consider them a government.
Correct.
I love this guy. I mean, we don't. Trump is many things. We don't deserve him when it comes to that, because that's the most important thing imaginable. It's so very important. It really.
Well, let's go back to the foreign exchange market, because I think this is a good way maybe to wrap it up. Is historically, to your point, London was the financial center. Yes, of course, New York was as well. But if you look at the most liquid foreign exchange crosses, until recent years, they were dollar, yen, and sterling. Yes. Not dollar, yen, and euro. Euro has obviously been making a big inroads into the sterling cross liquidity.
Right.
And what I mean by cross is, let's say, this is a real world example. One of my clients at Morgan Stanley, that Seagate Technology, which has a big manufacturing unit in Thailand, they needed to move their corporate funds from their Thai subsidiary to the mothership in Silicon Valley. That would typically go through the Japanese yen on its way to the US. Why? Because there's no liquidity between the US and the Thai dollar and the Thai baht. The liquidity is all in the region between the dominant currency in the region, which was the Japanese yen. Okay. Right. And by the way, it took them 6 days to move their own money around the world. Right. So actually this is on my website from 10 years ago. Why did Seagate make an investment in Ripple? Because they were trying to solve this very real problem. How do I move my own money around the world? Much faster, right? And there's all this float just trapped in what the treasurer called comfort deposits. The comfort deposits are the money that you can't move because it's just waiting to be settled.
Right.
And when it takes 6 days to move their own money from one subsidiary to another around the world. Now, granted, Thailand is an unusual example because it has capital controls, but it's not that far off from the real world problem that corporate treasurers face.
Right.
Okay, so this is why stablecoins are going to be a killer app. The
Yes.
biggest challenge is they haven't had legal, regulatory, accounting, and tax clarity.
Mm-hmm.
That is all about to be solved. Frankly, Custodia, with what we've done with Vantage Bank, stay tuned. We'll be doing more. We announced the first tokenized US dollar bank deposit issued on a permissionless blockchain 2 weeks ago.
Nice.
And the incoming from that was huge. And we'll be doing more. So the banking industry itself is the market opportunity here, and it's great. Yeah, no. And a lot of the banks, believe it or not, are really interested in this because they see the problem and their clients see the problem, and they see this as a solution to solving that very problem that Seagate was talking about. So now back to the three dominant currencies in the world: dollar, yen, sterling. We see what's going on in Europe. It's retrenching. The euro has been taking some of sterling's market share, but the honest truth is they're going to continue to retrench. And the fact that nobody wants euro stablecoins and there's literally virtually no demand,
right.
and it was a free market. People were issuing them and asking for forgiveness later, and the market didn't want them. Right. And so much so that Tether actually got out of Europe and isn't even bothering to get regulated under the MiCA requirements right now.
Well, what's really interesting, yeah, no, let me stop you there. Just to put a final point on what you're talking about. Europe shot themselves in the foot two ways. First, Martin Armstrong pointed out the 8 years worth of negative interest rates, but I'll take it one step further. Looking at the SWIFT RMB tracker that comes out on a monthly basis, where they track the percentage trade and settlement of of how trade is settled and whatnot in various currencies, from the moment Europe put the sanctions on Russia and said we're not buying Russian oil and gas anymore, through the percentage, the euro was climbing. The petro euro was happening with the Russian European energy trade. They were settling up with like 35% of non Eurozone trade around the world because they were buying so much freaking Russian oil. Right. And that collapsed in the first year of the war in 2022 from 35% to 13%. And the US dollar took the entire friggin' market share. And they shot themselves completely in the foot doing that. Yep. And all of a sudden I'm like, guys, you were building the petro euro. You were building the thing that you could then force the euro onto people. And you then said no.
They didn't see it. They didn't understand it.
They didn't understand
and they didn't understand it with stablecoins either. It was a not invented here thing. And they did, but although ironically, the guys that run Tether are Italians, living, Italian citizens, like people who were educated, grew up in Italy. This is no secret. Right. So it was in their own backyard, Tom.
I didn't know that, but I was an Italian. Didn't? I'm like,
oh yeah. Oh yeah, absolutely. Yeah. In fact, actually, Paolo Arduino, who's the current CEO, he was the CTO, came to the United States, visited the United States for the first time a couple of weeks ago. And everybody was thinking, oh, he couldn't come onshore in the United States because, law enforcement would grab him. And lo and behold, he's now made 2 trips to the United States, and that has not happened. No. So again, I come back to, that is a company the U.S. powers that be have decided is going to succeed, stay alive, continue to push the U.S. dollar out into the hands of the billions of people in the world that are unbanked and literally the traditional financial system can't figure out, because the compliance costs are too high, how to bank them. And Tether they're building kiosks in Africa where people don't have places to power their phones, where you can swap out batteries. It's brilliant what they're doing. They're just building this huge distribution network with no competitor. And the U.S. has clearly decided, by simply not shutting it down, that this is going to be a channel to increase not just dollar demand, but the resilience of the U.S. dollar system, and moving away from London, which is why I wanted to bring in that supplemental leverage ratio discussion and the stablecoin discussion, because these are all huge pieces of the puzzle.
They really are, and I'm really glad that you clarified that for me, because this is something that literally came into my head like 3 hours ago, and now I'm like, oh, I almost feel like I could actually talk about it like an intelligent human being, and that's so
Great.
yeah, no, this makes perfect sense, and this I'm really glad we did this because you can see why there's such panic now in Europe and why they're freaking out, and it tells me that their next move is going to be catastrophic. They have to now literally go to war with the entire with what they have left of their hooks into the American financial system, and what banks they have on Wall Street that are in their corner. Remember, we go back to my original thesis. Okay, so who's on the American side of the ledger, who's on the sovereign side, and who's on the Davos side? Like, so we have J.P. Morgan, we got Goldman Sachs, we got Morgan Stanley, and then we have BOFA, Bank of New York Mellon, and a couple of others that we're not really sure about. And it's gonna be very interesting to watch over the course of the next 2 years who gets bought, who gets destroyed, who gets decapitated in this war. It's going to be
Very
very
interesting. And
very
yeah, but remember,
I
for
don't know where
bank M&A,
I
the
don't know where
Fed has to
Citigroup
approve
falls.
it. Yeah, good question. For bank M&A, the Fed has to approve it.
Right.
And we know where the Fed is.
Mm-hmm. Exactly. So it is going to be interesting from here. And so what this is all coming down to is that the whole Trump, I want to get rid of Jerome Powell thing is complete WWE kayfabe. Like he's actually pushing Powell
Part of the deal.
to not cut interest rates to prove that the Fed is independent. If you read what's happened in the last 48 hours with Trump like screaming out, Powell should be, I gotta get rid of this guy, he's awful. I'm like, oh my God, can you be more
He's
obvious?
Definitely not going to get rid of
24
him.
hours after Scott Bessent says, oh, I have breakfast with Jerome every Monday. Like, like we're working this stuff out. Like, it's so funny. I'm like, and everybody's like, dude, like, I'm like, no, there's clearly what
your thesis is really funny because it means the Fed is controlled by Democrats. It's 4-3 Democrats. And your thesis is really funny because you're laying out that the Democrats are actually helping Trump.
Has the definition of Democrat, I mean, when at this level, like think about this. Everybody in New York, okay, let's back up for a second. Jamie Dimon's a Democrat.
Yes.
Okay, but Jamie Dimon in the primary season backed Nikki Haley. Now, and everybody went, oh my God, he's backing the neocon. He's backing the terrible Waffle House waitress from Greenville. No, what he actually did was tell everybody on Wall Street, it's okay to vote for a Republican in this election.
Yeah. Okay.
And then he came around and slowly but surely started saying nice things about Trump. And then he kept saying, oh yeah, no, we have to do this and we got to open up. And then he goes to Davos and says, we're going to drill, baby, drill. And then he goes to Davos and then he goes on CNBC and he says these, I watch Dimon carefully and it's clear that he's like so at this level, at this point in time, I don't think party matters. I think everybody was
well, let me lay out something.
I mean, that's
we said earlier. Nobody will benefit more from a relaxation of the supplemental leverage ratio requirement than JP Morgan.
Right. So
it's the biggest bank.
It's the biggest bank. And I just think that our with the ground shifting as quickly as it is, and with the game board shifting as quickly as it is, at the end of the day, like what used to be these alliances and these definitions, none of those things matter anymore. All of a sudden, like I'm looking at my copy of Dune right over my shoulder. I'm like, oh,
yes, I see it.
And everybody's like, okay, it's time to make new alliances. All right, what are we doing? Like me, let's go in the back room. Let's talk about this. Like that's the game. Like, and on Wall Street, it's going to be about who makes the most money and how they're going to protect their business. And when it was in their fiduciary interest to go along to get along with whatever the globalists wanted them to do, that's what they did. And I just caution everybody when you say, oh, the banksters are evil and this. I'm like, well, yeah, when evil's ascendant, it's what they have to do. When the world changes and we now have other opportunities to make money, like I've always said, like I don't think any of these guys care whether they build a pipeline across America or they build a pipeline across Russia. They don't care. They just want to run the book on it. Like,
right.
They just they don't care. They're not ideologically driven other than run their system, run their bank. So if you give a guy like Jamie Dimon, you give John Solomon and the rest of them the opportunity to run the book on recapitalizing America, and that's where the best
they'll be right there.
Investment is, they're going to go there. Yeah, it's not hard, and you don't have, and you're not going to get an apology out of these guys. Like, they're sharks. Yeah. Are you going to ask a shark for an apology? Are you kidding? No, of course not.
Yeah. Yeah.
We shouldn't ask for one. So this has been fascinating.
All right. Yeah. Amazing. Right. We definitely went long, but this was fun. And we do this every, I don't know, 6 months or so.
Right. So
I think the world's going to be very different in 6 months. Let's put a pin in it. Whether the precipitating event for a major market disruption is coming in 6 months, I'm going to put the pin down to say, though, watch what happens with the supplemental leverage ratio.
I think you're absolutely right. Caitlin Long, it's been lovely to speak to you as always. We'll do this again soon.
Sounds great, Tom. Good to see you as always.
As always.
Always make me think.
Mm-hmm.
Cheers.
You too. Bye-bye.